All right, everybody, welcome back. So in this video, we're going to continue discussing the introduction to options. And today we're going to talk about intrinsic and extrinsic value. Now, we've kind of touched on this a little bit, but I want to go just a little bit deeper, make sure that we have a really good understanding of what it is that we're trying to grasp here. So in the last video, I talked about its moneyness. And when we get into the moneyness of something, it has to involve the intrinsic value of a product. If you can exercise that option and see profit from that because it has its own net worth or its own inherent value, then it has intrinsic value. And what I would point out here, looking at the options chain, is the intrinsic value when we are out of the money is at 0. And that's because when it's out of the money on the call side, they're farther out in price. There is no intrinsic value. Now on the put side, out of the money, going lower in price, there is no intrinsic value. Right? So it's a known thing. We can calculate it. We can quantify it. For an example, if we look at the current stock price in SPY, we first have to recognize, well, what are we talking about? It's not this number because the market's not open yet. So that was the last traded value of the stock. We want to just get rid of that. Instead, we want to focus on what's the right now value. What's the bid and the ask? Well, it's 424.39 or 424.37, right around in there. Notice that the intrinsic value on the 424 is keeping up with the ask, right? So when this goes to 45, that goes to 45, 48, 48. Because this is 424 plus 48 cents gets us 424, 48, 49. Okay, so that's the 424. Well, what about the 423 or the 422? It would be the same thing, right? You take the current stock price of 424.57 and you look at 422 and subtract those two from each other and you get the intrinsic value. Easy peasy, right? Well, how come the options value is, say, $8? Why is it so high? Well, intrinsic value is only one of the numbers. We also have extrinsic values. Now, when it comes to extrinsic values, it's saying that there is something giving this option value, and it comes from something other than its moneyness, something other than being in the money. What gives an option those values? Well, time is money. So if an option has a lot of time, you will see that it has a lot of extrinsic value. For an example, if we were to go very far out in time, say 140 days, and then we look at the extrinsic value, there's a lot of value here. It's why these options are $2,500, $2,600. And yet, if we were to go really close to the money, there's almost no extrinsic value left, right? Because if we're very close to the expiration, all the time value is gone. So this extrinsic value, a lot of it is time value, 140 days to expiration. That's a lot of time value. But it's not only time. Another thing that makes up extrinsic value is volatility. If an option has a high volatility, it will be more pricey. It will have a higher value, right? And it's purely swollen value. The analogy that I always use for this, and it makes perfect sense and everybody seems to grasp this really well, is if you think about soda, Pepsi, Coca-Cola, Dr. Pepper, if you go to Costco or Whole Foods and you buy a case of soda, you're basically paying 12 cents a can. How much did it cost to make that soda? Right around 10 cents, 12 cents. You're basically at cost, right? You're getting it really, really cheap. That's its inherent value. It's what it's worth. If we had, take the aluminum and the sugars and everything, that's it. It's about 12 cents. But if you take that same can of soda and you go to the ball game or to a movie theater and you try to sell a 12-ounce drink there, even just in the can, you can sell those things for $2, $2.50, right? So it has a high extrinsic value due to external factors like where we're selling it at, right? And supply and demand. At Costco, there's all kinds of soda. When you get to the ball games, it's, what are you going to do? Stand in line for 4 hours to get into the game and then decide you want a soda and leave the game and go somewhere to get a soda and come back? No, you're going to buy it from right there. So they can set whatever price they want, knowing that they are the only supplier and there's a high demand. So it's the same thing with these options. When the implied volatility gets really high, these options become very expensive. Their cost, because the extrinsic value goes up a lot. The really neat thing is we can see that on a chart. So if you go out to the chart and you put on an implied volatility indicator, you could use this for a visual representation of how are the options in that product right now. Are they kind of cheap or are they kind of expensive? Now remember, its intrinsic value is set by the stock price, and so that is what it is. But the extrinsic value is set by external factors like volatility and time. I'm going to give you a demonstration or an example of what an average option cost before COVID hit, when things were a lot cheaper. So the implied volatility before the event was around 10, sometimes 12, and up to 15% implied volatility. We're looking at January 13 of 2020. Let's go look at the options on that day. So we can go to the think back. We'll look at SPY. We will set this to January 2020. And we'll look at the first day of the year. One thing that I would point out is look at the average implied volatility back then. 8, 9, 10, 11, very low values. And the next thing I would say is, well, let's look at 13 days to expiration. What was an at-the-money option 13 days to expiration? What was it running at that time? And how much extrinsic value did it have? An at-the-money option 13 days to expiration had an extrinsic value of about $1.94. The average option was running at about $2.50, closer to $3. Okay. Not too bad, right? $1.94 of extrinsic value, 13 days to expiration. If we come into the current market and we go down, well, we don't have a 13, but we have a 14. So let's go back to the Analyze tab, go to Think Back, and we're going to make it 14 because we want to really compare apples to apples. So the extrinsic value was $2.83 for an at-the-money option, 14 days to expiration. Here we are, 14 days to expiration, an extrinsic value of $9.27. So time value is the same, 14 days to expiration, 14 days to expiration. We have the same amount of time, and yet this option has an extrinsic value of $2.83, and this option has an extrinsic value of over $9. Why is it so different? Well, it's not time, right? Look at where the volatility was at the first of the year in 2020 before the event, right? Before COVID. And now look at our current level of implied volatility, what our new normal is. Now, granted, we're sitting near the high end of normal, but this is our new normal. Back in the day, our new normal, or our old normal, was much, much lower. And so was the average cost of an option, right? Its extrinsic values were so much lower. And this is why when we're talking about options trading, we say keep your eye on volatility. Because if you're trading a longer, like a swing trade, and you buy a call while volatility is high, and then that volatility falls, well, your call is going to lose money from that strip of volatility. We call it volatility crush. When that volatility gets crushed out of your option, it's losing a lot of its extrinsic value. It's just getting sucked out of that thing. So you may buy a call when we bounce off of the lows and see price run to the upside, and that call will make you money because price did move in the right direction for you. But at the same time, you're not making as much as you would have made if it hadn't lost all that extrinsic value from taking a volatility crush. Right? You can see here, for an example, where SPY rallied off of that bounce. Right? It hit the low and it started to rally to the upside, and look at how much volatility was stripped out of that option. 15 points, more than 15 points from that low to that high. And yet, if we had bought calls, sure, we would have made money, but we also would not have made as much money as we could have made because it lost all that extrinsic value. So extrinsic value also has a little bit of interest rate in it. And if you're day trading or you're trading in a very, very short duration, then it's not really going to affect you that much, but it is there. And, when we want to be fair and honest when we talk about options, and that does include interest rates. It's called RHO, R-H-O. So that is a value that does make up some of the value of that option. Okay, well, you got to ask, what's the interest rate? Now, of course, like I said, if you're just day trading it or very short duration, you would never need to really look at RHO. I can tell you, I trade options constantly, and I never look at RHO. Perhaps I should, but I have never been able to identify any edge by looking at the RHO and perhaps thinking I should choose a different strike because of the RHO that I see, or that I should choose a different expiration because of the RHO that I see. I've never had that situation. So it is there. We want to recognize that that is a part of the extrinsic value that exists, but I give it no weight. Right? I don't give it any weighing at all into the extrinsic value, into the moneyness of the option. So that's it, guys. That's intrinsic and extrinsic value. I appreciate your time and look forward to seeing you at the next video.